Most multifamily deals still do not work today. Prices came down from the peak, which was like 2021, 22 maybe, but debt got more expensive, insurance went up, taxes went up, payroll went up, maintenance went up, and a lot of sellers are still trying to sell based on the numbers from 2, 3, or even 4 years ago. I look at deals every single week that still don't cash flow. People hear that prices dropped and assume everything suddenly became a good deal. And it's true, prices definitely have dropped. But when I'm making my offers, I still have to have a discount beyond that. For example, if somebody's now asking 150 a door when it could have been a good deal 4 years ago, I'm still coming in at like 100 a door, 120, 130 max sometimes a door. So I'm anywhere between 80% and even as low as 50% of asking price right now. Even though that asking price today, yes, it's discounted from where it was 3 or 4 years ago. And again, when people hear that prices dropped, you assume that every deal now is going to be a good deal, but it's just not the case. Because a deal that barely worked at maybe 3.5, 4% interest usually is going to get crushed at 7% debt, unless the pricing was so far down that it was enough to offset it, right? A lot of owners still haven't accepted that who are looking to sell, and they're still trying to get that inflated sale price. Some sellers are trying to sell based on projected returns still, like the pro forma, which we always used to do, and you typically could do, projected occupancy, even projected renovations, projected appreciation. Meanwhile, the buyer, us, who has to deal with the real numbers today, are getting stuck with a headache or things that are not actually going to pencil properly for us and our needs. You can't really buy a deal that doesn't cash flow. Of course, you can. Some people do it for appreciation. Some people are able to operate at better expense ratios somehow, and maybe they're even vertically integrated where they can potentially offer a bit more. But why do that to yourself? Why get into a situation where it's just so thin that you're not really making any money? And it's important to understand that disconnects between sellers and buyers are still happening today, regardless of the fact that there are discounts. And back in 2020 through 22, a lot of operators got hurt with that floating debt. They purchased properties assuming that rates would stay low forever and that rents would keep climbing forever. Some of those deals had almost no margin for error from the beginning. Then insurance doubled, debt payments exploded, and now people are trying to survive long enough to either refinance or sell at a loss, sometimes at break even, or even allowing the banks to take over the properties. And part of all this has to do with the movement of new operators, new groups out there, just like me, just like myself, who are gung ho trying to get a deal done, trying to get involved in the multifamily real estate game, thinking that this was going to set them financially free forever. And I knew a lot of people that quit their jobs and jumped into multifamily real estate just to go right back into working their W-2 jobs because the market cycle and the deals are not permitting cash flow enough to the point where you can retire, guys. It's just the reality. So I eliminate deals real quick. I'm not looking at deals hoping that they're going to work. I'm looking for reasons that they don't work based on my standard underwriting. Some key things that a lot of people miss are taxes being reassessed after they purchase a property. It doesn't always happen within the first year, and depending on the location, the municipality where your property is, the taxes may not adjust for years, right? But you have to know that. The insurance quotes, if you're not dialed in with insurance in your particular market, you have to be, and you better be, because the bank will make you get a certain amount of insurance. And if you find out that insurance is way more than you anticipated right before closing, you could be screwed, and maybe you should back out of that deal. Also, what happens if occupancy drops? Because we all know today, across the United States of America, occupancy is down. We can go into the reasons of why occupancy is down, but I think we kind of all understand that for now. Occupancy is down. Delinquency is up. Turnover is up. What happens also if renovations take longer than expected? Maybe you have permitting issues. Maybe you have staffing issues. Maybe you have supply issues for the products that you're trying to use for your renovations. Maybe your plumber is going to get diagnosed with diabetes this week, which is exactly what happened to us. So when you're looking at your deal and you do a quick underwriting or a full underwriting, and you're looking at your NOI and you think it looks pretty good, and then you see the debt service, how much cash flow is left after that debt service? I'm talking about absolute numbers, not necessarily percentage of cash on cash. Because in absolute numbers, Maybe $5,000 a year might be a 10% cash on cash, which is unrealistic in my opinion. But looking at that $5,000 a year, could you live off it? Or is it just going to be coffee money? And that's how you should consider things as well when you're looking at returns. Honestly, I would rather buy a conservative deal at a 7.5% fixed rate debt today than gamble on appreciation and refinancing assumptions that I can't control 3 years from now. A lot of people made money during that time period where almost everything went up from 2020 to 22. And that created the illusion that every deal was a good deal. But appreciation can hide bad operations and bad underwriting for only a certain period of time. Eventually, the debt catches up. And I'm more interested now in survival and durability. I want fixed debt. I want realistic expectations, realistic expenses. I want enough debt coverage where the property can breathe a little bit. I want to buy at a basis that makes sense relative to replacement cost, as well as where pricing was 3, 4 years ago and where it is today. Because I'm not buying these deals for 1 year. I buy deals for ownership over a long period of time, 5, 7, 10 years. If I can slowly build up my equity in these deals, maintain good occupancy, operate well, and learn how to operate in these difficult markets, survive these difficult years, and hold long enough, that matters a lot more to me than trying to force some crazy, ridiculous, giant return expectation or projection in year one. So for me, if a deal is super boring, but it survives and it is able to cash flow even at a minimal level, for me, that is a win compared to a deal that we go in with high expectations that is super exciting and then just we bomb and crash and burn. And I think that this market is exposing the difference between people that were underwriting for reality and the people that were underwriting for hope. There are still opportunities out there, and I truly believe it. But I just want you to be honest with yourself, be honest with your underwriting. You can't force deals to work just because you want to own something, okay? And this is crucial. This is what I had to go through as well. There were stages of my development of emotions and feelings and trying to get involved in multifamily real estate where I thought that I could buy anything and make it work because I have the will and the gut and the determination and the knowledge and the time to really put in whatever it would take to make any deal work. And it's just really not true because there are other contributing factors that we also and always have to take advantage of or take into consideration, like the market cycle, like the property itself, the location, the demographics, and the overall broader economy that is affecting everything today as well, potential wars. So there is a lot more to think about, regardless of whether or not I have true faith in myself as somebody who's willing to work hard and has the ability to push through challenges. There's other factors that are going to make deals more challenging than they need to be. Buy at a good basis today. Make sure the deal cash flows at today's debt. Make sure you have realistic expectations for your expenses, whether that be 50%, 45% expense ratio, maybe even 55%. If you can make a deal cash flow at 55, 60% expenses, which is nearly impossible, if you can make it cash flow, even if it's 2, 3, 4%, I am calling that a win. But you also, on the flip side, have to understand how to underwrite deals. And if you don't know how to do that, I teach it. I teach it with my multifamily machine cohort. You can go right now to my Stan store and check it out, stan.store/buy buildings. And you can get a bunch of free resources and also join my cohort. It is the best multifamily cohort. I truly believe it's the best multifamily education platform right now that you can get involved with. Go check it out today. And if you don't want to get involved, share it with somebody that you think could get some value from it or is super interested in learning about real estate. So for today, guys, and for this week, continue looking at deals, just like always. Just make sure that you're underwriting properly. Make sure that you have realistic expectations for expenses, for occupancy, for debt, and for requirements for insurance and tax adjusted pro formas, etc. Make sure you know what you're doing. If you don't know what you're doing, again, reach out to me and I would love to get on a call with you and talk about my multifamily machine program, where I've so far helped 20 people really improve their journey in the multifamily game. And I helped 2 people hop onto an awesome team. So hit me up. Have an awesome week. Love you guys.